So I would just add to that this last week in our work, industrials, which we've been warning about with clients and talking about the individual names and the sectors or the sub-industry groups, I should say, but industrials as a whole actually turned negative in our relative trend work. Now that comes, and this is important because that's coming as it's at an increased level in our SERM work. SERM work, what the heck is that? Standard excess return model. So it shows what the risk-adjusted returns for a sector, industry group, et cetera, are over time. And what we had was this elevated reading within industrials that just said, look, unless you believe trees grow to the sky, you've had about as good a run as you could expect in industrials. That tends to be an early signal. It's a lot like a valuation signal, though it's all price-based. And then once that rolls over on a relative basis, that's where we pull the ripcord. And so, you're seeing it in aerospace and defense, and you're seeing it in machinery, and you're seeing it in professional services. So that is absolutely right in line with what you're talking about. And then interestingly, seasonally, we actually end up with a pretty soft patch for the next roughly 6 months for cyclicals versus discretionary. So we'll see how that plays out. Welcome to RenMac Off Script, where we discuss markets, economics, policy, history, and life. It is the 21st of February, 2025. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Chaplet.
A lot of charts in our Twitter feed this week, our LinkedIn, and you can always join us at RenMac Access for more information. We're going to hit on what's going on in Washington. We're going to hit on housing. We're going to talk about China and industrials here. Hit the mailbag this week. But first, let's figure out what the hell's going on with Neil and that shirt. Neil, where are you? Don't tell me you're in Brooklyn or New Jersey for that matter.
No, I'm not. I'm in Mexico. Where else?
Yes.
I got on. You gotta, when in Rome. I'm at the Nickelodeon resort here in Mexico. So when in Rome, you gotta put one of these Garfield shirts on.
I mean, that does it. Watch out for the pedophiles, I guess. So you go see, I go ski. I'm in Telluride. It is going to be like 50 degrees here today. So after about 2.5 feet of snow, so good stuff. Let's get started with housing. What do you got for housing for us this week?
Well, the housing data was, uniformly, softer, I think, on net. Now, obviously, the January data was a bit of a throwaway, I think. Yes, it was a little bit weaker than expected, but a lot of that is just could be a function of weather. Obviously, housing is very much affected by, unseasonable weather conditions. But I think more importantly is that home builder sentiment was worse. It was much worse than expected, and that's a February data point. Now, I think it's interesting what the NAHB said about that, right? Because they basically blamed tariffs as a sort of primary rationale for why the number was worse. I think that's a little rich, quite frankly, because it wasn't just a few months ago that they were very upbeat because they were, sort of hoped up on the deregulation potential coming out of the administration. So they went from being optimistic around deregulation to being now pessimistic because of tariffs. As if nobody knew, as I recall, he ran on being the tariff man. So now that he's actually going ahead and doing it, you're worried about it. I think it's kind of amusing. Or it's something much more simplistic, which is interest rates are too high, and that's weighing on housing demand. That's the issue, okay?
Right.
You're in a situation where incomes are slowing and interest rates remain elevated. What do you think that means for housing? Lower.
Right.
Duh. Right? So you can use any sort of ex post rationalization you want, but ultimately that's it. And that kind of brings me to something where, kind of the opposite of late 2022, like setting the table. If you recall back then, we were very sort of making this kind of out of consensus call about there's not going to be a recession in 2023. Most of the consensus was on the other side of that call. Why do we make that call? Number one, labor incomes were accelerating. The sort of the shock from the Ukraine invasion was fading, right? Food and energy prices basically were round tripping by the end of 2022. The labor markets were still fine. So as a result, real incomes rose. That's number one. Number two, the Fed was hiking, and yet housing stocks, the housing market was okay, was doing better actually. If you recall, towards the end of 2022, home building stocks were outperforming. Number three, everyone was primed for recession. That was, that was the call. Everyone
Yeah.
was talking about recession. Fast forward to now, labor incomes are slowing, real incomes are actually moderating, right? Because the labor market's cooling off. That's number one. Number two, even though the Fed has cut, housing is getting worse, not getting better.
Right.
Number two. And number three, recession expectations in the marketplace have largely evaporated, right? No one's anticipating anything bad happening. So that's kind of like setting the table. That's where we are. So to me, that just means the risks are elevated. Now,
Yep.
I mean, so, and these are now those are the two big things, right? Housing was getting worse, labor markets were worsening, right? You can talk about tariffs and deregulation and uncertainty and all this and deportations. I just think that's largely a red herring. I mean, people are using that as kind of an ex post rationalization for something that was already entrained to begin with, right? We already knew that government spending was going to slow, particularly from state and local governments. People are pointing to Doge. I mean, that's sort of like it's kind of this heads I win, tails you lose kind of thing, right? I mean, the same people that are saying this is like a huge problem for the economy are also the ones ridiculing it when Trump says we're going to give a $5,000 dividend. They'll point out like, well, actually, it's only $4. So which is it? Is it really bad or is it nothing at all?
Right.
Right. So
Right.
to me, it's like state and local governments were a big tailwind. They're not a tailwind anymore. Consumer spending was a big tailwind last year. It's not as big of a tailwind now because the labor markets are slowing and the housing market's getting worse. Right. Does tariff threats and uncertainty, does that help? No. But that's not really I mean, people want to point to Trump, obviously, but the margins in Congress, I mean, Steve can talk to this, are very, very thin. So getting legislation over the finish line, that was going to be a problem regardless of who was in office.
Correct.
So
Correct.
it's sort of I just find it kind of interesting, like what people want to focus on. Like if you want to use Trump to make it's like to rationalize away your forecast from last year, by all means go ahead. I think that's like, I mean, it's very obvious what you're doing at that point as a forecaster. In my opinion, things were already getting worse. And the fact that goods producing employment was already contracting, right? Um, you know, to me, the quits rate was already very low. The hiring rate was already very low. I mean, there was a lot of things there that kind of told you that things might be slowing down. And so when I look at it, the consensus hasn't yet adjusted their expectations. So that's kind of where I'm at. I think, to me, I think that it sort of pays to be cautious right now. And I think the cyclical areas of the economy are getting worse to the extent that, you're seeing layoffs go up in the DC area or whatever else that people want to point to. I mean, that's a added dimension of the slowdown, but that's not really the main thing that's going on, in my opinion. The cyclical areas of the economy have been weak for quite some time.
So I would just add to that this last week in our work, industrials, which we've been warning about with clients and talking about the individual names and the sectors or the sub-industry groups, I should say, but industrials as a whole actually turned negative in our relative trend work. Now that comes, and this is important because that's coming as it's at an increased level in our SERM work, what the heck is that? Standard excess return model. So it shows what the risk-adjusted returns for a sector, industry group, et cetera, are over time. And what we had was this elevated reading within industrials that just said, look, unless you believe trees grow to the sky, you've had about as good a run as you could expect in industrials. That tends to be an early signal. It's a lot like a valuation signal, though it's all price-based. And then once that rolls over on a relative basis, that's where we pull the ripcord. And so, you're seeing it in aerospace and defense, and you're seeing it in machinery, and you're seeing it in professional services. So that is absolutely right in line with what you're talking about. And then interestingly, seasonally, we actually end up with a pretty soft patch for the next roughly 6 months for cyclicals versus discretionary. So we'll see how that plays out. But I'll tell you what, I mean, exactly what you're talking about. This is why people are such bad investors, because they let their emotions and their ideology get in front of investment decisions. And that doesn't tend to be a good mix. It's like drinking and driving, you know? Both are fun in isolation, not a great combination. So, when I look at that and I see what people are doing, I mean, they're trying to jam square pegs in round holes. And we sit back and look at what's going on from the market's message. Clearly, that is what the market is telling us as well.
And also, by the way, I mean, one last thing I would add to this, just to put a pin on it, the Fed doesn't have your back right now.
Right.
Right? They've gone from being proactive to reactive. Basically, what they're telling you is they're waiting for permission from the data before they cut. So you're tempting fate, right? If you're waiting for something bad to happen in order to do something, to respond, guess what? The likelihood of something bad happening goes up, not down.
Yeah.
Right? This is an important distinction from where we were last summer when the Fed basically, they sort of went peak hawkish in June, and by September they were cutting 50, and they were
Yeah.
basically backstopping the labor market. So this period kind of reminds me of the period between June and September, right? Where if they're waiting for something bad to happen, maybe something bad will happen, and it's just another sort of added dimension for why to be cautious. But I got to hop soon. But one of the things I would love for you to focus on is, and I think our listeners were too, is you mentioned the sort of litany of negative kind of industrial names. You mentioned aerospace and defense, and I think this will be a good sort of segue for Steve. You know where one area defense stocks are doing really, really well?
Yeah, I know.
Europe.
Say it.
I wonder why. But it's like I mean I was thinking about this before. It's like he's not doing anything about inflation. Well, then he just is trying to fire a bunch of federal workers. No, not like that. He's not doing anything to get the dollar. He wants to get the dollar weaker. Oh, but we don't want Europe growing that way. So pick. You can't have everything, right?
So
Anyway.
before we go to mailbag, because we won't, but somebody did have a question I think is relevant, and it wasn't about that shirt, though it should have been. Maybe next week it will be. Does Neil Dutta have any nicknames? I mean, I'm not going to use the one that I use, but go ahead.
Okay, this is gonna sound bad, but my friends from NYU, they call me Stoned Neil, all of them. Now, you might think that has something to do with,
With that shirt you're wearing. Yeah.
right, but it's not. Actually, I don't know, for whatever reason, like I didn't get enough sleep in college, and my eyes were always bloodshot, so they always said I looked that way, and so that's what they call me.
Really, it was from the Mace with the girls.
Anyway, all right,
All right.
I'll
Have a
talk
good
to you guys
vacation,
soon.
dude. All
Yeah,
right.
thanks, man.
So, Steve, we talked about with Neil, we talked about the industrials and the weakness there. Obviously, a lot going on with Doge and the like. We saw more confirmations this week, but really, I mean, there's so much is going on. I know they're flooding the zone, so we have you here as a referee. What were the most important things that you saw?
I think domestically, the thing that's been the most interest here, at least within Capitol Hill, is this whole Senate moving their own version of the budget resolution and the House coming back next week. Does the House have the votes to move forward with the one bill approach? Trump came out and actually expressed his preference, something he's sort of been reluctant to do in terms of the one bill versus two bill approach, backing the House one bill approach. Some people thought that was sort of a shot at the Senate. I think I saw it a little differently. I think that may actually be a sign of weakness in the sense that Neil referenced the fact that the majority in the House is extremely small. It's very narrow. And it's unique because usually the Senate's the choke point. That's where you have the small majority. This time it's House. And you're going to have over 200 personalities and districts to deal with in terms of what the varying interests are compared to Senate, where you're only doing with about 50 or so. So the pressure is really going to be on Speaker Mike Johnson next week to deliver this budget resolution. And he's already sort of making suggestions that maybe we won't have it next week. It could be the following week. These things don't age well. And I think that's why the Senate is going ahead with their two bill approach, basically to give Trump an off ramp and keep pressure on the House. So that's really important. And the other thing that I would just point out is the House bill is noticeably different than the Senate bill for two reasons. One is that the House bill includes the tax cut extension, and the Senate bill would delay. That would be the second bill. That would be later in the year. The other thing that the House bill does, it addresses the debt limit. The Senate bill doesn't do that. So I think that's really the thing to watch next week. It's sort of been the interest here, at least domestically. Internationally, everything's, I think, on Europe. I don't think it was a coincidence that President Trump sent Vice President Vance over to deliver his speech at what I would call more the Munich Insecurity Conference. I think that was deliberate because a lot of European leaders last time were just sort of, let's just try to wait Trump out and hope that somebody else comes along. I think Trump's message there is, this is my successor. I know Trump was reluctant to anoint Vance with that title for obvious reasons. He doesn't want to accelerate his lame duck status, but I think it's more a message to Europe is this person's likely to succeed me, and his views may be more hawkish than mine. So why don't you work with me here to try to find some off ramps on things like the situation in Ukraine? I think Trump also sort of brings everything to the table with respect to including defense as part of discussions over tariffs and the like. So there was a reason that the European trade minister was here in DC last week.
And just your quick take, I don't want to belabor it because we don't know, all the underpinnings to this, but Zelensky, I'm sorry, the envoys, Rubio, and whatever the equivalent for
Lavrov for Russia.
Yes, thank you. I can barely say my own name. And the Saudis, obviously, out of that mix was Zelensky and any envoys from the Ukraine. Knowing this administration, that was purposeful, that sending a message with that. What is that message as you see it?
Well, I mean, at this point, I'm not sure it'd be productive to have representatives from Ukraine and Russia in the room. I think there's probably a more productive role for the US to play to sort of shuttle back and forth to try to work out what the contours of a deal would be before we actually assemble both sides at the negotiating table. That's my personal view. So I see some merit to the approach. There's been a lot of speculation with the public deterioration of the relationship between Trump and Zelensky this week. I mean, look, people forget, and they shouldn't, the fact that Zelensky was part of the first Trump impeachment. Like, there's no love lost there between the two. Trump wanted Zelensky to go ahead and sort of unearth the investigation into Hunter Biden and Burisma and all that. He sort of refused, and then Trump sort of withheld some military aid, and that was we talked about this issue of impoundment, which, interesting, we're coming around again as to what the president's role is there. So, does Trump prefer that you negotiate with somebody other than Zelensky? That may be one area of agreement that he has with Russian President Vladimir Putin, that both might like to see somebody else at the negotiating table than Zelensky. So, I think that's an important personal dynamic because it really drives a lot of this stuff behind the scenes that people may not necessarily be accounting for. But we'll see. It's also possible that by criticizing Zelensky, maybe he's actually bolstering Zelensky's appeal at home. I'm not sure. I even checked the Ukraine polls recently.
Right. Well, talking about the U.S. market, we talked about the deterioration in industrials, which is a component of cyclicals, obviously. The three components of cyclicals as we see them historically are industrials, tech, and discretionary. The good news is tech is back in a leadership role. Discretionary is, though it kind of limped in there. We talked about that several weeks ago, but it's still okay. Not great, but it's okay. And so still giving the nod there to those from a bullish perspective. The percentage of issues above their 20-day moving average, which for us is a little bit more of a high hurdle than NYSE breadth. People talk about breadth confirmation, and that's fine. It's a pretty low bar, to be honest with you. That's just the cumulative sum of how many advancers there were versus decliners on any given day. So you take advancers minus decliners, you use that number, and then you add the similar formula to the next day as it goes, and you create this cumulative sum. That's a much lower bar, how many names were advancing versus declining on a cumulative basis, but that's what's known as NYSE breadth. For us, we use the percentage of issues above their own 20-day moving average because it's a little higher bar. It just tells us how many are really participating in the short run. And that's been gravitating off and on, up or down, right around 50%, which is a relatively low number given a new high in the S&P. So just keep that in mind. This is not everybody's participating type of market. This is still very selective or relatively selective. Obviously, the performance measures, momentum continues to be important in this market, but it also signifies to us what kind of environment it is. If you've got momentum, like we did in, say, December of 23, people were skeptical when we made that call. But when you have momentum back then, the risk is not being invested. That is the risk in a momentum market. In a non-momentum market like today, The risk is chasing names. You don't have to buy the breakouts. You don't have to buy things that are very overbought. You can actually wait for things to come in, consolidate. You're still in an uptrend, but it's a little bit more of a tactical strategy around that. So the only other thing I would add to that is what we're seeing out of China. And I do want to bring Steve back in on this. Obviously, Hong Kong having a great move. Alibaba was up 12%. I think that was overnight, but I think that was overnight last night. So it's always hard in China. Their overnight is our morning, etc. But the great charts. We've been talking about China for almost a year now on this pod. 6 months ago, really leaning into it, consolidation, and then moving. That looks like a big base. If you saw our work on Bloomberg, our interview on Bloomberg, we relate the China call to where we think the U.S. was in 2008, 2009. I think it really is a turning point there. And Steve, that's what I want to just ask you about from a political standpoint. And this is something we discussed back in December. Is it possible that everybody's so bearish on the policies and the tariffs and Trump being very, very hard on China that their back might be against the wall so much that they're willing to have these concessions and actually come to some type of agreement? Now, whether they honor it or not is another story, but actually come to some type of agreement, which is completely outside the realm of most people's thinkings just, a month to 3 months ago. What do you think? What's going on there?
Well, I think when you look at sort of where we stand right now with the initial tariffs, those are the only tariffs right now that are in place. Trump put a 10% tariff on Chinese imports, all imports, and China sort of retaliated with a very measured approach. A lot of them targeting U.S. energy interests in terms of fossil fuels. And I think the way it was interpreted from China, with 10% rather than the 60% that Trump campaigned on, was let's accelerate a conversation. And I think China appears open to that conversation again with more of a measured approach, not looking to escalate tensions further. So maybe to your point, there is a desire, because I think from the Trump administration's perspective, China's in a weaker economic position relative to where they were 8 years ago. You've had this concern, especially from the Biden administration in Europe and other places, with respect to China's overcapacity. Basically, they're trying to export their way out of these things. So they're maybe particularly vulnerable to these tariff threats that they may want to avoid. On the tech I guess, bounce there in China. I think that's interesting because I go back to sort of this DeepSeek concern over AI. And we're in this race. The U.S. is in a race with China over who's going to be the leading developer here of artificial intelligence, and the idea, hopefully to achieve some of those productivity gains. So I think it's interesting that Xi's now trying to embrace a lot of the tech community that he banished a few years ago.
Right.
He was exiling Jack Ma and the others. We didn't even know that guy was around. Well, apparently he is. He's shaking hands with Xi now. So I guess I could see it being a good.
He's missing a finger though. When he shakes his hand, maybe two.
Maybe two. I don't know. I couldn't see the other hand behind him. But I just bring that up in terms of it's probably good in the short term because I think Xi sees them serving a useful purpose. But just like you saw last time, he can turn very quickly once that usefulness, in his opinion, is no longer there, and that they might actually become a perceived political threat if their influence grows too much. So I guess that would just be my caution as to, how long do you want to remain in that trade? Maybe it's months, maybe 1 or 2 years. I don't know that you want to necessarily be there long term.
Well, what's interesting, right? The semiconductors in the U.S. they peaked in July of last year. They've been under pressure for a good 6+ months now. But in China, they actually look much different. They're very bullish. They're coming out of big bases. So that's a pretty unusual circumstance. I mean, one of the things that we find in our research is, birds of a feather flock together. And that's true globally, right? If pharma's going to do well, guess what? European pharma and Japanese pharma will do well also. It's very hard to, kind of distinguish those things because look, whatever's happening in the world is probably happening with that same symmetry, if you will. So it's really unusual to see these. I mean, I'm talking really good charts. In fact, we put one on Twitter earlier in the week. I think it was China Telecom, but the same flavor, if you will, right? So semiconductors, telecom names, even the banks, and that's the other thing that when people get really bearish or they're really concerned, and I get it. Watch the banks because the banks are still in really, really good shape. They're leading in Europe, they're leading in China, they're leading here in the U.S. Neil's concerns about recession, I think it's absolutely worth keeping an eye on. particularly as we lose industrials, but financials are not suggesting that. And that's usually something that you'll see come under pressure if we're kind of rolling along with the data that we're going to see some bigger problems as we go. So yeah, so China still looks great. Semiconductors, tech leading it, but you're absolutely right. This is 100% an arms race in terms of AI and computing power and owning that as we go forward. So we'll see how that plays out.
Yeah, I just think that might explain like the increase in semiconductors in China, because in order to pursue this AI race and tech race, they're going to have to rely more on Chinese semiconductors. You're not going to assume that you can rely on US semiconductors. And, I think if you just look at the performance of Intel, that's one of the things, in my opinion, that has been missed. The CHIPS Act was really designed in a lot of ways to turn Intel into a domestic chip producer, and it failed. And I think, there's a lot of questions now. What does that mean for the US moving forward?
Well, and let's be honest. I mean, if this is going to be the single focus for 2 or 3 or 5, countries going forward, the European Union, the US and China, does that put Taiwan back in play with Taiwan Semi, right? So how important does that become now from a geopolitical standpoint? So all things that we're going to have to keep our eye on. Well, let's talk to our favorite Taiwanese, I guess, immigrant. I mean, he came over, right? Harry Chen, our producer. Harry,
Yes, sir.
what do you think about the Chinese regime?
To be honest with you,
I know you don't want to talk about it.
Okay, he doesn't want to talk about
it.
to be honest with you, peace.
Okay, peace. There we go.
Yes.
All right, Harry, mailbag. What do we have this week?
Okay. We have the question from Mr. Mike Zaccardi, and his question is, what to make of AAII very bearish? BOA-FMS mutual fund cash ratio multi-year lows. Retail still buying stocks. Lots of contrarian cross currents.
Yes. So the AAII the AAII data shows a lot of bears. The Bank of America mutual fund cash ratio is at multi-year lows. In other words, people are fully invested. Retail is still buying stocks, question marks. There's a lot of contrarian concerns or cross currents out there. So Mike and others, when we look at sentiment, we actually have what we call our master sentiment model. The whole point of sentiment really to make a strong call. And by the way, there's I think something that's very important within sentiment that does not get played much, which is there's a certain asymmetry to sentiment. And that's true in a lot of things in this business, where an indicator might be good at a top, but not good at a bottom. An indicator might be good at a bottom, but not good at a top. And they can actually still be statistically meaningful, but not work. And sentiment's one of those that doesn't tend to work as well at a top. So just one thing to keep in mind. I know that's not the question, but we'll get into that. So even when we get elevated sentiment readings, we're less inclined to be as proactive with those or use those as meaningfully as we do at bottoms. They tend to be much better. I think part of that, and we can get philosophical here, I think part of that is just the wiring of human behavior, which is, fear is a core to our survival, for millennia, right? Fear was important to survive. And so fear is a much more innate instinct. Greed is, let's say developed, if you will, not quite as an emotional response. So I think that's part of the problem. But one of the things that's important for sentiment, and this is why we have a master sentiment indicator, is looking at the totality. If people are fishing from both sides of the boat, there's really not a lot of harm or opportunity, frankly. What we concern ourselves with, and it's really important in our sentiment models, that we're looking at different strata of investors, right? We want the retail investor, we want the professional investor, we want the option player, we want the futures market player. So you really have to get down to the core. And when everybody, the professional and the most the most retail investor are thinking the same way, that's where we have a concern. So sentiment to us right now is slightly favorable, and that is with the bull bear ratios, just as you hit on the AAII, and our favorite, frankly, is Investors Intelligence, but I don't make enough of a distinction between what's happening in sentiment to actually make that be a market call. But that's a great question. Mike Zaccardi, congratulations on your RenMac hat. I'm in Colorado, so it might be a couple weeks before you get it, but I think one of our associates will send that out. We don't have Neil to talk about what's on the docket next week, but what do you see, Steve Pavlik from DC?
I mean, really, it's good, like we sort of mentioned, that vote in the House, whether or not that vote happens. And I think that's gonna be the thing to watch here. And then looking abroad, do we see any more?
So let me ask you a question on that. What's the probability in your mind of a government shutdown?
Well, so next week, again, this is the budget resolution on the
Right.
reconciliation package. At this point, I think looking at March 14th, I think the odds of government shutdown, I would probably put at 25, 30%. They've actually come down a little bit. I was probably at 40, 45% until earlier this week because some of the political calculus has changed a little from the Democrats. There's been some conversations, particularly pressure on progressives to try to shut down the government as a way to stop Musk and the Doge, which has been a concern from some of their constituents. The current thinking, or some of the moderates, is, hey, are you actually going to embolden Musk and do his bidding by forcing government shutdown? Because the president has some discretion as to how painful you want to actually make a shutdown in terms of which areas are deemed critical and can stay open and which ones aren't. So I think there's some fear if the government shut down and people don't really notice or miss some of these things that they're no longer receiving, does that sort of give Musk and Republican lawmakers more momentum to actually remove them? So I think probably looking at a short-term continuing resolution. Now, Democrats are going to want something in exchange for a vote to keep that government open. So that's why I say 25, 30% tensions are still high. But I think also you have to figure out too is, are you going to have this vote next week on the budget resolution? If it looks like it's proceeding, presumably Johnson, that's a good sign for him. He has good control of his conference. If it fails, then there's going to be some tension there. And you're also talking about maybe inserting the debt limit as part of that March 14th government funding deadline. Again, if Republicans can't remain unified and get this budget resolution through next week. So that's a good way to think about it, I think. And then abroad, I think still what's going to happen here on the Putin, Trump, Crown Prince Mohammed bin Salman summit, looks like some progress was made this week at the staff level. I don't know if we're gonna have a meeting next week, but we may see more additional steps and perhaps an announcement of a future meeting date.
Yeah, let's hope so. So from a market perspective, clearly losing industrials is important because it is part of that cyclical call. Again, that's, kind of the first cut, if you will. What we don't want to see is that cut become infected, right? And so infection, we'll see how broad that cyclical trade comes under pressure. We'll see how financials react, and we're going to be watching spreads very carefully because, those tend to be the linchpins, not only the spreads for the market overall, but we'll be watching the spreads specifically within those sectors and those industries, and clients will certainly see that work as we send those details around on a daily basis and keep monitoring that. If you have a question, don't forget to post that on YouTube. I'm sorry, on Twitter. If you want to see this podcast, you can watch it on YouTube. But remember, markets are always complex. Good analysis doesn't have to be. So keep those questions coming. We love to see them. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and subscribe to that YouTube channel. And until then, I'm Jeff DeGraff.
And I'm Steve Pavlik.
And who wants to do Harry, do the Neil Dutta voice.
I'm Neil Data.
Okay, yeah, that'll fly. We'll see you.